It is 2021 and the technology industry is booming. So if you're looking to invest some of your money in stocks, you should take a look at the tech companies. In this video, we show you the cheap tech stocks you can buy right now. Before we begin, don't forget to give this video a thumbs up, subscribe to our channel, and click the bell icon for notifications. Why cheap tech stocks? The technology sector consists of companies that build, market, and develop electronic components and software. Recently, information technology (IT) services such as cloud storage are increasingly being provided by tech firms. While the most well-known firms include Apple and Microsoft, there are also penny stocks in the technology sector. Penny stocks are very cheap and normally sell for $5 or less per share. Penny stock investment is highly volatile and will result in higher trading costs. As a result, investors should exercise caution when deciding whether or not to participate in these related securities. Without further ado, let's get right into what stocks you should be investing in. The list consists of cheap penny stocks, but also companies like Microsoft that are big but have low risks to invest in. Just follow the simple rule of investment. Don't put all your eggs in one basket. Microsoft. Microsoft may not be a flashy new software company or a hot new tech initial public offering (IPO), but it is continually innovating, pivoting, and evolving to remain on the leading edge of technology. According to Bloomberg News, Microsoft's next move is a proposed $10 billion purchase of messaging site Discord. Microsoft's gaming and Azure cloud services businesses are thriving, according to analyst Dan Romanoff, and the company's potential to generate sales and margin expansion at a $1.8 trillion value is remarkable. MSFT stock has a buying rate of a fair value estimate of $263. BlackBerry. Depending on your generation, you might recall seeing this gadget as a child at the beginning of the mobile age, or you might recall using one of the first smartphones. This Canadian business came into the scene during a period when mobile media was changing the laws of the game. Some phones sell more, but few had the network protection and durability that this phone manufacturer from Canada did. Its phones were sponsored by its network, which was so stable that it became the preferred work phone for Wall Street and Washington, D.C.'s key players. It was a brilliant computer, and with its physical QWERTY keypad, it was almost as cool as the iPhone. But then the iPhone and a slew of other touchscreen rivals arrived, complete with the applications and modern designs, leaving BlackBerry in the dust as a relic of the past. As the spotlight shifted away from BB, it tried to do what it did best: secure networks. The stock was recently one of those stocks that Reddit community investors rescued from obscurity. However, it's a cutting-edge engineering portfolio with a lot of upside potential. It also leased the phone to a different business. The stock is up 83% year-to-date, indicating that there has been a lot of competition in this low-cost player lately. However, it's already a successful business with a promising future. Taiwan Semiconductor. Taiwan Semiconductor is the world's biggest integrated circuit maker. Going into 2021, TSMC was an outstanding long-term growth prospect, but the firm already has several bullish catalysts in the short term. TSMC is benefiting from Intel's INTC problems with high-performance computer chip processing, according to analyst Felix Lee. According to Citigroup, Taiwan Semiconductor would earn $560 million in increased revenue for every $2 billion in additional processors it develops for Intel. The ongoing global semiconductor shortage, according to Lee, is good news for chip prices and TSMC's margins. Lee believes TSMC is well poised to profit from secular acceleration developments in artificial intelligence, data processing, and high-performance computing technologies in the long run. TSM stock has a hold ranking from Morningstar with a fair value estimate of $136. Okta. In the identity and access management (IAM) industry, Okta assists businesses in protecting their online identities and making it simple for consumers to access their accounts. IAM may seem to be a small part of the software industry, but it's rising quickly and is now worth $55 billion. Okta's offerings have been a vital part of several corporations' IAM plans, and the company's recent development has been nothing short of spectacular. In the fourth quarter, revenue increased by 41% to $234.7 million. Year-on-year, the number of consumers with annual contract values of $100,000 or more rose by 33%. With Okta's current development and management's forecast of a 30% increase in overall sales in fiscal 2022, there's always space for this firm to expand. As a result, Okta's recent share price decline has provided an excellent investment opportunity for software investors. Ideanomics, IDEX. Ideanomics is a venture capital company that specializes in promising technology ventures that need capital to expand. At this time, it's mostly concerned with electric vehicles, EVs, industrial electric vehicle financing, and batteries and energy storage. It also has a capital branch that uses artificial intelligence, AI, and blockchain technology to offer financial services. The business has attracted a lot of attention in the last year or so as institutional ESG, environmental, social, and governance investing has increased, and electric cars have become trendy tech stocks. IDEX is working on hybrid cars in both the United States and Asia, including electric tractors and motorcycles. ServiceNow. ServiceNow offers software as a service (SaaS) solutions for managing and automating enterprise operations and workflows. ServiceNow shares are down 7% year-to-date in 2021 after a strong year in 2020, but Romanoff believes the pullback is an outstanding investment opportunity. ServiceNow's land and expand policy of securing new clients with creative products and then cross-selling additional items to current consumers would proceed in the future, according to Romanoff. ServiceNow's total transaction size is increasing, according to Romanoff, and the company's willingness to boost revenue to current customers is remarkable. Square. Square's payment processing infrastructure taps into a massive and rising digital payments industry in the United States, which is expected to be worth $2 trillion by 2025. Square's payment terminals are widely used by retailers, but the firm is now widening purchases made via its online platforms. In 2020, the amount of card-not-present payments via online channels increased by 26%. Additionally, Square's Cash App, which helps consumers to compensate each other and pay retailers, has seen a 50% increase in monthly transacting active customers to 36 million in 2020. And those consumers have made several purchases with the platform, raising the gross payment amount (GPV) to $377 million in the most recent year, up 162% from the previous year. Square's price has dropped by around 10% over the last 3 months, along with many other software companies. Square's latest decline looks like a bargain for investors searching for a great software bet on the burgeoning digital payment sector. Glu Mobile. Yes, Electronic Arts have recently confirmed the acquisition of Glu Mobile, a small gaming business. However, since the sale isn't supposed to close until the second quarter of this year, there's still time to purchase GLUU stock. After the tech bubble burst in 2001, Glu Mobile was created, and its reliance on cell phones and tablets appeared optimistic at the time. Although that is no longer the case. The bulk of other gaming stocks is late to embrace smartphone gaming. GLUU makes a large portion of its money through sales made by applications that promote brands within its games. Typically, these are games that can be found in most big app stores. MLB Pick Sports Baseball and Covet Fashion are two of Glu Mobile's most well-known titles. Overall, EA's decision was likely influenced by Glu Mobile's portfolio and prospects. It's also why, even though the sale falls apart, GLUU is already a fantastic business in its own right. Wipro. This multinational engineering company headquartered in India has had an exciting ride. The Western India Palm Refined Oil Limited started operations in 1945. It was a store that sold processed edible oils. As India expanded, it discovered new opportunities. As the West grew more involved in India's rising economy, it started to form partnerships with major American companies. By the mid-1990s, WIT had evolved into a technology firm. It had sold off the rest of its non-tech company units by 2012. It's also a multi-billion-dollar IT solutions and logistics company with major activities outside of South Asia. Adobe. Adobe is the industry leader in cloud-based creative applications, marketing technology software, and e-commerce software. Adobe's Creative Cloud division, which includes Photoshop and Illustrator, leads the industry according to analyst Dan Romanoff, and its Experience Cloud represents a massive long-term growth potential. Adobe's Advertising Cloud, Analytics Cloud, Marketing Cloud, and Magento Commerce Cloud companies are also part of the Experience Cloud. Adobe's shift to a subscription model, according to Romanoff, has consolidated its revenue development trend, widened its reach to more low-end consumers, and aided in the war against piracy. Adobe will continue to release innovative items and features to help the businesses leverage its Sensei AI software, boost consumer service, gain new customers, raise average sales per device, and cross-sell its artistic and technical services, according to him. And that's all for today's video on cheap stocks to buy now. Which company are you thinking of investing in? Let us know in the comments down below. And if you like this video, give it a thumbs up, subscribe to our channel for more such content, and we'll see you next time on the channel.